the Fed indicated that we're going to get at least 2 more rate cuts between now and the end of the year. So bullish, bullish, bullish. And so gold's got no place to go but up. Silver's got no place to go but up. The Fed wasn't independent. There was a general belief that it was. And now that's falling apart because they're pulling back the curtain and they're showing everybody that there really is no Fed independence. So I think the dollar is going to tank. But more significantly, gold is going to rally and rally big. The Fed indicated that we're going to get at least 2 more rate cuts between now and the end of the year. So bullish, bullish, bullish. And so gold's got no place to go but up. Silver's got no place to go but up. But let me get to these 3 other very significant, news items of the week. One is I watched an interview with Stephen Moran this morning on CNBC. Now, Stephen Moran was the head of Trump's economic advisors, who is now serving a stint as an FOMC member. So, he's wearing 2 hats, although technically one hat, he's got checked. He's going to go pick it up. So it's obviously a big compromise of Fed independence to have a member of the Trump administration infiltrating the FOMC. But 2 startling comments that he made. One was he said that rates need to be much lower because he says the Fed is way above neutral. And not only is he wrong, not only are we not way above neutral, we're below neutral. We're too loose. The Fed should have hiked rates, not cut them. That's what the market is telling you. That's what the long end of the bond market is telling you. That's what the gold market is telling you. Nobody wants to listen to those market signals. Look at the money supply. Look at what's happening with consumer prices, right? We have high inflation, well north of 2% and headed higher. But I think an even bigger admission that should be even scarier if you're holding U.S. dollars and not gold is that Moran said that in answer to a question about the dollar, he said that one of the Fed's mandates is not a strong dollar or to worry about the exchange rate of the dollar. He says there's nothing in the Federal Reserve Act that mentions the dollar and that it's not up to the Fed. He said that the policy regarding the dollar, that lies with the president, right? Not the Fed, which should be very scary because if the Fed doesn't care about the value of the dollar, how is it going to deliver on its primary mandate of price stability? Because price stability relies on the stability of the dollar, because prices are a function of the value of the dollar. If the dollar is losing value, you need more dollars to buy stuff. So in a way, when the Fed is mandated to maintain price stability, it is also being mandated to maintain the purchasing power of the U.S. dollar. So to say that the dollar is not a part of the Fed's mandate either means you don't understand what the Fed's mandate is, or you're just lying. And so either, it's one or the other, but there's no, third option. So he's on the Fed, and Trump is going to appoint a new Fed chairman that is going to share that perspective. In fact, one of the president's closest confidants, or was at one time, Steve Bannon, he came out this week in favor of the president nominating Scott Bessent to be Fed chairman while he is still Secretary of the Treasury. In other words, Scott Bannon thinks that the chairman of the Federal Reserve and the Secretary of the Treasury should be the same person. One guy wearing both hats, or gal, depending on who's there. That is a horrible idea. I mean, often those two work together, but they shouldn't. There should be like a Chinese wall there. In fact, the Secretary of the Treasury, of the Chairman of the Fed, needs to push back against reckless monetary deficits and fiscal policy. Gold is now up 40% this year alone in 2025. Silver is up 48%. These are incredible returns for precious metals, especially given that last year was also a very good year. But the only thing that's outperforming gold and silver are the gold and silver mining stocks. Today alone, both the GDX and the GDXJ jumped 5%. 5%. We didn't even have really a 1% gain in the price of gold, or almost, I guess it was about 1% because it was $40, so a little over 1%, but 5%. So we had 5 times the move in gold stocks today as we had in gold. And the GDX closed at an all-time record high, never been this high. And the GDXJ is the highest it's been in 13, 14 years, something like that. On the week, the GDX was up 3.75%, and the GDXJ was up 2.2. The star of the day was Barrick Gold, which was up 10% in one day. That's rare for a company that big to be up 10%. Normally, you might see some smaller companies, although all the gold mining companies are small when you compare them to the tech companies. But in the mining universe, Barrick is, I think, the second biggest, following Newmont, which, was still up almost 5% on its own today. So not too shabby there. But these are all big moves. Year to date, the GDX is now up 113%, and the GDXJ is up 115%. Right? So these stocks are doing better than tech stocks. Year to date, the S&P 500 is up 13.3%. 13.3%. Gold stocks are up 10 times as much. 10 times as much. So what's the big deal? And in fact, if the S&P is up 13%, but gold is up 40%, what does that tell you? That means in real terms, the S&P is down 27%. This is a major bear market in stocks if you price them in real money. But nobody's pricing them in real money. They're pricing them in funny money. And so you're getting an inaccurate perspective. Now, in other markets that were significant on the week, the dollar was actually only up slightly on the week. I think that's going to reverse, but it's still very weak, the dollar index. What was also up were bond yields. Again, I was forecasting that when the Fed started to cut again, long-term rates would rise, and that's what's happening. The yield on the 10-year finished the week at 4.13. On Tuesday, the day before the rate cut, it was 4.02. So the Fed cut by 25 basis points, and the long end has already gained about half of that. It'll probably gain the other half next week. The yield on the 30-year is 4.74. So I think the dollar is going to tank, but more significantly, gold is going to rally, and rally big. And one of the reasons for that is Morgan Stanley, just the other day, I think it was either Wednesday, maybe Thursday, but Wednesday, they came out and they officially adjusted the 60-40 portfolio. Now, the 60-40 portfolio is kind of like a mantra on Wall Street. It's how everybody should allocate their investments between stocks and bonds. And the benchmark is 60% stocks and then 40% bonds. And the only time they tweak it is as you get a lot older and you're retired, they will reduce the stock portion and increase the bond portion. But the standard cookie cutter model is put 60% of your portfolio in stocks and put 40% in bonds. Well, Morgan Stanley came out and said, we think that needs to be changed to a 60-20-20 portfolio. Still 60% stocks. They are reducing the bond allocation. They're cutting it in half. And they are replacing the half that they cut out with gold. So now you have a major U.S. investment bank telling its clients that now have 40% of their portfolio in bonds, that they need to sell half of their bonds and buy gold, right? Because the only way you can go from 40% bonds to 20% bonds is to sell half of your bonds. So in effect, what Morgan Stanley just did is they put out a sell recommendation on U.S. Treasuries, because U.S. Treasuries represent a pretty big part of that 40% that is allocated to bonds. Now, this couldn't come at a worse time for the Treasury because the U.S. Treasury now has to sell a record amount of bonds, right? We have unprecedented deficits that were just exacerbated by the big, beautiful bill. Yet investors, if they follow the advice of Morgan Stanley, and if more major brokerage firms and investment banks follow their lead, because Morgan Stanley said that you need to do this as an inflation hedge, right? It's clear that inflation